Welcome, folks, to our latest episode of Hung Chin Hon Sweatin Money. Just to start off with a disclaimer, we may or may not have ownership or other positions in the stocks mentioned on this show. Beware of conflict of interest. Don't buy stocks based solely off of what you hear from this podcast. We're not experts any more than you are. Always do your own homework and research before buying and investing in stocks. We are not your fiduciaries. And just to let you know, I'm your host, Kong. And today I'm flying solo, so my host, Gi-san, is not here. So let's look at what's in the news. Bloomberg says women-focused funds where companies either have a woman CEO, concentrate primarily on the women-centric market, or who have over 50% of the market in their workforce actually do better. John Callaghan told Bloomberg why he thinks stocks are sustainable, and I hope that's the case because I have a nice portfolio of tech stocks. Tom DeMark predicted that Chinese stocks would fall to 3,200 back in June and even predicted in late August that it would go further down to 2,590. He says that the fall to this point may be drawn out due to Chinese government intervention, but says it should bounce back by 4%. And the Federal Reserve will announce whether to raise rates on September 17th. Some analysts say it'll have adverse effects for the economy to raise it while the markets and the economy are volatile. But people at the Kansas City Feds say that it may not be a big deal. It may hurt certain sectors like trade, but certain service industries like healthcare, education won't be affected by interest rates all that much compared to trade-based sectors like durable goods and construction. Reuters reports that labor union organization United Auto Workers has struck a deal with Fiat Chrysler as the company to set the pattern for the entire automobile industry or manufacturing industry. Veterans get about $28 an hour, while new hires range from $15.78 to $19.28 an hour. So they're trying to close the wage gap between the veterans and the new hirees. And let's take a look at what's in our portfolio. So news is short this weekend. I didn't feel like repeating much of what we mentioned, mainly raising rates, China's stock downturns, and currency devaluation and such. So it's a good chance to take a look at and review some stocks that we have in our portfolios. In this case, oil stocks. Conoco Phillips has lost 39.2% since I bought it, while Chevron has lost 34.87% since my purchase. This, however, is including some of the additional partial shares that were bought through DRIPs, or dividend reinvestment plans, where I take the dividends the companies give and plow it right back in. So the actual capital loss is actually bigger when you don't factor this in. The oil sector has been hit hard, but those two have been the worst hit in my portfolio because it surpassed the stock, American States Water. It's hard to describe to the audio listeners on iTunes, but our video listeners can see a chart that actually looks pretty bad, but it really looks worse than it is. It looks like the stock was gaining value at the beginning, only to lose and then flatline out, where I then dump a crap ton of money where it loses half of its value. But what really happened was that there was a stock split in July of 2013. So while my chart says that I'm down around 30%, if you look at the actual values, it's actually much higher. When you also look back at oil, Exxon Mobil looks pretty bad, but slightly better, according to the bad calculations on my charts, than American States Water. So if you have these oil stocks to either sell it now and cut your losses, since there are rumors that oil can go down to $20 a barrel, or hold back onto them until they come back up, whenever that's going to be. What I plan on doing is at the end of the month, when I get my paycheck, is put some options on these stocks and gain back some of my losses. Then, when it does come back, I will have gained a bit and saved myself from paying seller's fees. One oil stock I had to cut my losses on was Brasileiro Petrobras, or PBR. I should have shorted these guys the moment I bought them. I wasn't looking carefully and didn't realize that when I purchased them, they had stopped passing out dividends. The only saving grace was that the prices were going up for a bit there. However, government policies have messed with Brazil's economy, and the U.S. SEC are still conducting investigations into Petrobras' alleged bribery. Then, on top of that, Standard & Poor's downgraded Brazil's credit rating, and I only wish they could have waited until the end of the month to declare it, so I could have gone in there and put options on them. And that's it, folks. Thanks for listening to today's episode. I know it was really short, but hey, that's what happens when you lose a wingman. All right. Well, hopefully Gibson will be back with us next week. All right. Thanks for listening.